This is Bazaar Morning Call. Live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Us here on a fresh new edition of Bazaar Morning Call. We are coming to you live this Thursday morning from the CNBC-TV18 Motilal Oswal studios. I am Prashant, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. Not at all. In fact, looks like today is also going to be a pretty ugly day. But let's see how things for now. There's a large selling that we've seen from foreign institutions overnight.
Well, that's right. The heat is on in the equity markets, but I think, at least here in Mumbai, cooler this morning in comparison to the last few days, I think. So, pollution, I don't know. I felt it was still as much because, I was riding to work. But otherwise, it's a little cooler. So, hopefully, it's better times for.
Glad, Nigel, you felt that too, because I was wondering, I've been up since 2 in the morning last night. I couldn't sleep. And I woke up in the I sort of, got my neck out of the window. Cooler and not stuffy and muggy, right? So I said, well, is it because I've not slept or it's nice to get confirmation that it is cooler?
I'm wondering why you can't sleep. I mean, it's happening very often.
Yeah, I mean, I need to fix that. But, not tracking markets, that much I can tell you. I didn't look at markets at all. But, all right, let's just quickly tell you what you need to know and, sort of start with the most important stuff, right? The US market. And selling continues. You have sharp cuts overnight. The Nasdaq was down almost 2.5%. The S&P was down about 1.5 as well. The S&P is now firmly below the 200-day moving average, which is at about 42.38. The next level, in a way, for the S&P to watch out for is around the 41.77 zone, which is the 55-week moving average. We are pretty close to it. A weekly close under it opens up more downside on the S&P and then the US market as well. Yields, which on Monday, as we started the week, if you remember, in the second half, the 10-year in the US had hit about 5%. It actually hit 5% on Monday for the first time since 2007. Tuesday was a market holiday. We came back yesterday morning and, yields had sold off almost 20 basis points. Well, guess what? They're back at almost 5%. 4.95% of the US 10-year is where we are back at. What's going on? And I mentioned this yesterday as well. Data out of the US is strong, and the contrast is so stark. So if you look at the European PMI numbers, weak across the board. We had the PMI numbers from the US strong, right, above 50. And last night we had the September new homes sales, which surged about 12% or so. And that's the reason why, you call it US exceptionalism, right? That's the market which is continuing to grow at that size and scale at a pretty healthy clip as compared to anywhere else in the world. And that's the reason why you get yields which did what they did last night. But of course, equities are on the other side because, they're expecting the Fed to stay tight. Anyway, dollar index, that's back at almost, not quite 107, but 106.57. And by the way, this morning, I think the dollar has gone up a little bit more. Especially the Bloomberg dollar index, which is almost at, YTD highs. Interestingly, the space which has gotten hit the most is the small cap part of the market in the US. So I looked at, both monthly and year-to-date changes. The Russell 2000, which is the small cap index in the US, that's down 7% this month. It's down 4% for the year. Look at the changes in the S&P and the Nasdaq YTD. S&P still got 10%, Nasdaq still got 25%. Oil prices, they've also gone in the wrong direction. From our perspective, it's up about 2%. We are back to 90 on fears of Middle East escalation. So, that ground invasion of Gaza, which Israel has been talking about, it's not happened yet. But, commentary, etc., suggests that they will put boots on the ground and they will actually go in at some point in the future. So, we're not looking at de-escalation. We're only looking at perhaps escalation, at least in the near term. So, oil higher is not something we like. Anyway, the market here is sold off pretty hard. I think over the last many sessions, the Nifty is down some 600 points. And the levels don't change. We put these out yesterday during closing as well. Next supports for the Nifty stand at between 18,500 to 18,700 or so. I would reckon around, we don't get to 18,700, around 18,700, the market actually finds support. If we go there, that is. It's entirely possible. Very short-term resistance on the way up stands at 19,400, which is slightly above where we are at right now. markets are oversold. I mean, they were oversold yesterday as well. The, RSI, for example, is now under 30, both on the Nifty and the Bank Nifty as well. Now, typically what happens that if you are in an uptrend, a fall and oversold readings on RSIs under 30 get bought. It's only in, bearish phases, right, on outright bear markets, which I don't think we are in one right now, that markets continue to fall even from oversold kind of levels. So in that sense, what happens today, what happens in the very near term, I think will also be important. We were saying yesterday, perhaps a tactical bounce somewhere there. It's due. We just got a 45, 50 odd point bounce early in the morning, and that's it. The market came off and continued to sell off through the course of the session. So keep this in mind. Next supports for the Nifty Bank comes in at about 42,300. I mean, same levels that we put out yesterday in the morning as well. We're at about 42,830, not very far away. I think we get there. Immediate resistance is the 40-hour exponential moving average, which is, slightly higher than where we are. I think about 43,400 or so is that one. Mid caps and small caps, they sold off yesterday, but out of the Nifty, the mid cap, small cap indices, Bank Nifty, etc., the small caps actually lost the least. They were down only 0.25% yesterday. Mid cap index was down a little more. But I would say, that part of the market, smaller cap stocks still, because they've done so much, you just have to look at gains from March 31st when the rally really started. I think that's the space which perhaps is a little more vulnerable. So be careful there. Not just mid caps and small caps, but lower down the curve as well, especially on the SME board, etc. The GIFT Nifty will come up on your screen. I think we are indicating a 100 points lower start straight off the bat at about 19,022. Sonia.
Well, it's been a bit brutal, right, for the bulls over the last many days. I mean, there's no two ways about that. The Nifty has lost quite a bit of ground, and today looks like it's going to be no different. So let's just pull up the Nifty chart for you. In fact, if you take stock of the last 5 days alone, the Nifty has lost over 3.5%. So it's almost a 700-point cut that we've seen on the index, 670 points in the last 5 days. That's the kind of bearish trend that this market is witnessing. Now, yesterday there was large foreign selling as well. Let's not forget that the US 10-year yield has once again spiked to almost 5%. I think 4.8% is what we saw yesterday. So the Qs are not looking good. There was large foreign selling to the tune of about 4,200 crores. Yeah, 4.95% is where the US 10-year yield is. So there is once again risk aversion towards equities globally, including a market like India. There was a sell-off on Wall Street as well. I think NASDAQ was the one that got hit the hardest yesterday. NASDAQ was down over 300 points, as you can see on your screen. But in terms of our own local cues, I'm watching out for two stocks. Axis Bank, the numbers were quite good. It was the best loan growth that Axis Bank has seen in the last 7 years. So the street will definitely like that. But on the flip side, tech companies continue to report, uninspiring numbers. In fact, Tech Mahindra's numbers saw a big revenue and margin miss. The constant currency revenue was down 2.5%. The adjusted EBIT margins were down 400 basis points quarter on quarter. So it looks like that problem is not over just yet. And if there is, further escalation of the situation, the geopolitical crisis, if it has an impact on the global GDP, on the US, etc., then one pocket that could get hit hard is the IT space. So keep an eye out on that. There was also, some other smaller numbers like Jubilant Foodworks that reported a weak set of numbers as well. So all in all, the bulls don't have too many great cues to latch onto this morning.
Well, that's right. And the global cues are in favor of the bears, right? If you look at the yields, the US markets, you look at the dollar index or even crude oil prices. So the bears have things going for it. The Nifty, the question is whether or not it drifts to around the 200 EMA or it sees some kind of support at around the 19,000 odd mark, which is going to be an important zone, particularly for today. Select technical indicators, though, they're nearing, oversold levels. The question is whether we see a bounce today or does it come in the next couple of days. But my reckoning is, say, in the next 2 or 3 days, we're in for a bit of a bounce, and it could be, close to around 200, 250 points as well. Depends on, how the global cues do pan out. Yesterday, the vulnerable pocket of the market actually didn't get hit very, very hard. So on Monday, we did see a sharp downtick. But yesterday, at least there were signs of buying in the small cap as well as the mid cap index. Remember, that's the vulnerable pocket. So we'd like to see that outperform because that's what's going to be affecting your portfolios where the big money has been made. So the broader markets should definitely be on your radar and look to buy good quality, well-run managements. The rollovers since today's expiry pretty much in line. The Nifty and the market-wide rollovers very much in line with what we have seen in the last 3 series. What do the FIs do? They added close to 3,500 short contracts. It takes a net short positioning to around the 74% odd mark. So that short positioning has gradually been holding at around the 74% odd mark. And yesterday as well, they had 2 shorts for every 1 long position. On the option side, they bought calls, and they bought closer on 2 calls for every 1 put. But the way they're writing calls tells you that at higher levels, we're going to see some supply. Yesterday, they wrote closer on 16 calls for every 1 put in trade yesterday. And what were they writing? The 19,200 call. Very, very active. The premium came down from around 150 at the start of trade to around 30 rupees. The 19,300 call as well. The start of trade, it was 70 rupees. It ended closer around 10 rupees. So that's telling you the kind of aggression we have seen. Which brings us to the level. Since the 19,200 call was getting written aggressively yesterday, the 19,250 level, well, that becomes the first level of resistance. Support comes in at around 18,950. And I say this because the 19,000 put has the highest open interest. The premium out there is around 20 rupees. So you need to keep an eye out on that. And if we break that level, then maybe we slide down to around the 200 EMA, which is a very, very important mark. So there's 18,600 to around 18,950. Oh, that's going to be a very, very crucial support zone. The Nifty Bank, that's been the weak pocket. Yesterday as well, it took a knock. The 200 DMA, which was acting as a bit of a support, that becomes a bit of a resistance right now. So that's around 300, 350 points away from current levels. But I was talking about the technical indicators that are indicating a drift towards the oversold levels. One is the PCR. That's moved to around 0.67 odd. And that's, the lower end of the range. Normally at 0.65, we do see a bounce. Next is the FI net short position. In percentage terms, it's at around 74%. But if you look at it in absolute terms, it's nearing the 1 lakh contracts. Normally, when you see the PCR move to around 0.65 and you see the FI net short position move to around 100,000 odd, you get a bit of a bounce. So we pull back to kickstart trade. The gift is suggesting a 100-point pullback. Maybe, in fact, at around 19,000, 18,950 to 19,000, you see a bit of a bounce. Otherwise, we'll go ahead to test the 200 EMA. So let's see how we close out the series.
All right. Well, lots to watch out for today, but doesn't look like it's going to be a good start this morning. Let's take it straight to some money market cues because the Gift Nifty for now is indicating that we'll have a 100-point cut this morning. But here is what you can expect on the rupee today. First up, Parul Mittal Sinha of Standard Chartered Bank says that limited moves in the dollar and oil, along with likely US dollar sales by PSU banks, help the dollar INR trade in a tight range. She expects the pair to trade in a range of 82.90 to 83.30 this week.
Okay, well, on bonds, Parul says that India rates continue to trade range-bound amidst volatile global rates, West Asia tensions and fears of potential OMO sales. She says monetary policy is likely to remain tight amid higher global rates and risks around food inflation. She expects 10-year benchmark bonds yields to trade in the range of between 7.3 to 7.4% this week.
Well, we have a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Axis Bank, Sonata Software, Sona BLW Precision, Chennai Petro, Charlie Hotels. We have CMS Info Systems and GSW Infra. While stocks on the negative side, well, they include Tech Mahindra, Jubilant Foodworks, and Indus Stars as well.
Okay, well, we've got Cameron Brand joining us now. He's Director of Research at EPFR Global. Cameron, good to have you with us here. Thank you very much for your time. It's always about the flows at the end of the day, which determine prices, although people could say that it's the opposite as well. It's circular, in fact, and perhaps it is. But what are flows doing, especially, into GEM funds, into India-dedicated funds? What's the latest data telling you?
Well, since we last talked, the pattern that we discussed then has actually held up fairly well. I don't know if well is the right word, but we continue to see outflows from GEM funds, but fairly solid inflows into most of the major single country Asia funds, funds dedicated to India, Japan, Taiwan, and Korea. On the fixed income side, obviously a lot of stress in those markets, but from a fund flow perspective, investors are building up their position in higher yielding sovereign debt and aggressively cutting riskier fixed income classes.
Cameron, hi, good morning. This has actually been a couple of months where foreign investors have pulled out or redeemed money from the Indian markets. Do you think that's going to be the trend for the rest of the year as well?
Well, it's very much sort of two forces at work. The redemptions from diversified funds, it's not only the GEM funds, but it's the truly global funds as well that are getting hit, are definitely, sucking money out of India. India itself, though, remains very much in the good column for investors who are focused on emerging markets. And what we have seen recently is a shift away from taking on diversified exposure to going market to market. So dedicated India funds remain on a winning streak. Again, though, the totals have dropped a bit in recent weeks, still seeing above average flows week in, week out. The problem is, how much needs to come in to offset those GEM fund redemptions.
Hi, Cameron. Good morning. Good to have you in. Give us a broader sense. U.S. yields have spiked up. So how are you seeing flows towards the bonds in comparison to equities? And within equities, what are the flows between emerging markets and developed markets? Have you seen a change, say, in the last, month or so?
No, I really haven't. Certainly on the equity side of the equation, emerging markets continue to do better, though again, there have been betters in the not too distant past compared to developed market funds. And within that universe, there's definitely a big bias in favor of the emerging Asian markets. Most weeks, bond funds are taking in a bit more money than equity funds, but overall flows are fairly subdued recently. We're not seeing sort of big blowout numbers week by week.
Cameron, just curious to know, you must have read that tweet from Bill Ackman, who runs Pershing Square, widely followed and pretty generous with his opinion, especially on X now. But he said, well, they've covered their shots on U.S. bonds. Said, well, there are too many risks in the economy. The economy is slowing much faster than expected. What are you seeing in the U.S. bond market, and what are the dynamics there? The top dominating drivers to your mind.
The top dominating driver is yields higher for longer. There remains a lot of people here, both institutional and retail investors who've been trying to operate in a very low yield environment for a decade. So at least I think for the next few months, the demand will probably hold up surprisingly well for U.S. sovereign debt. Into next year, I can only agree that there are risks from all directions. And a thing we are starting to see is having accepted the consensus that U.S. interest rates will be higher for longer. The fund flows are indicating that energy prices are now also expected to be higher for longer. We're starting to see flows into dedicated energy funds really accelerate.
All right, we leave it at that. Cameron, thanks a lot for joining and appreciate your thoughts here on CNBC TV 18. Let's take a quick commercial break. On the other side, our list of top 10 stocks is lined up in just moments from now. Stay tuned. Welcome back to Bazaar Morning Call. We have lots of stocks to talk about, so let's get straight to that very quickly. First up on our radar is Axis Bank. Abhishek is here to tell us how the numbers looked. Abhishek, morning.
Morning, Sonia. So the numbers look really good. They have beaten our poll in terms of P&L performance, as the loan growth is the best in last 29 quarters or even more. So positive from the result is that they are one of the rare banks who have seen improvement in their net interest margin. Unlike ICICI Bank, which saw a decline of 25 basis point, and Kotak Bank, which saw a decline of 35 basis point, Axis Bank improved its net interest margin on a sequential basis. Deposit growth of 17.9% YOY is the best in last 7 quarters, and loan growth of 22.8% YOY is the best in last 7 years or even more. So annualized slippage ratio is at 12-quarter low, with the absolute figure of slippage at about 3,254 crore is the best in last 12 quarters on the lower side. Asset quality, they remain pristine. Gross NPA ratio is the best in last 30 quarters on the lower side, and again net NPA ratio is at 33-quarter low. The only negative from the result is that the cost to income ratio, that's at 5-quarter high of 50.24%. In terms of P&L performance, both the NI and PAT is a beat on our poll. Back to you.
Thanks a lot for that, Abhishek. So that one should relatively outperform today. But Rima joins us to tell us about Tech Mahindra, whose numbers are quite disappointing. Rima?
Tech Mahindra has reported a big revenue and margin miss. Revenues for the company have fallen for the second consecutive quarter, falling sharper than what the street was anticipating, down 2.4% on a quarter-on-quarter basis. The problem is communications, which is a third of the overall revenues, has seen a fall of nearly 5% sequentially. Discretionary spends in the telecom vertical are getting constrained. Reported margins are down to 4.7%. In fact, adjusted margins are down 410 basis points on a quarter-on-quarter basis. 4.7% margins are much, much lower than what peers are reporting. The company is prioritizing their business. They've terminated certain low margin contracts. They're not focusing on areas which is challenged, and that's resulted in certain one-offs affecting their margins and revenues. Deal wins are pretty healthy, so that's picked up on a sequential basis. Remember, the street was waiting out to find out the big strategy overhaul under Mohit Joshi. He clarified that it's going to be revealed only in April in terms of the steps to improve the margins from here on.
Okay, that's going to be an interesting one to watch out for. Will markets be charitable and look ahead with the new management in place? You can hear from the management and the earnings in a short while from now. Rima will be speaking with Mohit Joshi and Rohit Anand at 8:35 this morning. So that's coming up in just a bit from now. Well, that's TechM for you, but Jubilant Food is the other one which reported numbers. And here also seems like the recovery is not afoot yet. Perhaps a little more weight, Sonia?
Absolutely. It was a quarter that was weak on expected lines. So if you look at the core numbers, right, there was barely a single-digit growth on the top line. Just about 4.5% growth is what Jubilant saw on the top line at about 1344 crores. But the problem really is in the operational performance, where they are struggling. The EBITDA was down about 10%. The margins are down 400 basis points compared to what they saw same time last year. And the net profits are down almost 40%. Now, let's not forget that Jubilant FoodWorks has been a big underperformer in the last many months. The stock is down 11% in the last 12 months, but it is still quite expensive. It trades at 66 times FY25 PE. Let's take a look at what brokerages are saying. Goldman Sachs has a neutral. They have a target price of 515. They say, once again, it's a soft quarter from Jubilant FoodWorks, but the demand is likely to be bottoming out. They say the revenue is in line, and the management highlights that there are some green shoots. Morgan Stanley has an equal weight with a target price of 493. The quarter is weak on expected lines, so there are no negative surprises this time around. But yes, muted quarter, so I'm going with red on that stock.
Okay, all right, going with red on Jubilant Food. But let's go back to Rima. Rima, what about Sonata Software?
Sonata Software has reported a pretty good set of numbers. When you look at the consolidated numbers, it's a mix of IT services, which is largely export-driven, international, and plus they do a sale of their domestic products business. So the combined numbers have reported an improvement in margins on a quarter-on-quarter basis, 10.3% versus 8.8%. But the street focuses more on the IT services business as the international IT revenues, where the revenue growth has come in at 4.7%, and sequentially there is a margin improvement. For Industars, it continues to be a very challenging period. In that, maybe the company has performed well, but in terms of numbers, revenue growth just up 0.8%. Margins are slightly lower on a quarter-on-quarter basis. Their profits are down close to about 3.9%. And even the trade receivables have gone up on a sequential basis, perhaps on account of concerns on Vodafone Idea.
Okay, well, that's telecom in focus. Well, let's talk about Sona BLW. Sonia's got more. Sonia?
Yes, in fact, Sona BLW will be speaking with the management as well in a while from now at about 9:30. So stay tuned for that. Very, very strong numbers coming in for Sona BLW Precision. Now, the revenue growth both in Q2 and in the first half of the year has exceeded 20%. Remember, they have a large presence in the electric vehicle space and they're getting a lot of momentum from there. Orders are coming in thick and fast. Look at the margin expansion, 300 basis points expansion in their margin, largely due to the positive impact of the product mix. The company says that the light vehicle sales in the top three markets, which is North America, India and Europe, grew by 14% for them. And a lot of positive brokerage notes coming in as well this morning. CLSA has upgraded the stock to an outperform. They've raised their target price to 578. They say that the company has added new product lines and customers which will help them drive growth going ahead. Jefferies has a buy with a target price of 700. Sona BLW is actually a big proxy to this electric vehicle boom that we're seeing. And I reckon the stock could be in the green this morning. In the last 1 month, though, the stock has come off. It's down about 10%. So maybe there is some headroom on the upside as well. But Surbi is with us to talk about some more numbers that she's tracking. Surbi, morning.
Good morning. So the first one on my radar is Chennai Petrochem. Now it was a good set of numbers. Sequentially, the numbers are good because of the refining segment as they've done as due to the higher GRMs. Now the revenues are up 12% sequentially. EBITDA is up 90%. Margins at 11% versus 6% in the previous quarter, and net profit has nearly doubled at 1191 crores. Next is Chalet Hotels. A good set of numbers. Again, a good run for the hotel companies continue in Q2 as well. Revenue up 27% on a year-on-year basis, and hospitality business and their annuity revenue both have grown in excess of 25%. EBITDA up 48%. Margins have jumped to 40% versus 34% and 35% levels in the previous quarter and same time last year. And PAT is up 2.2 times. And lastly, CMS Info revenue up 15%, EBITDA up 9%, margins at 27%, and net profit up 16%. So good numbers from CMS Info as well.
Okay, thanks for that, Surbi. Well, let's wind this down with Vivek, who's joining us to tell us about JSW Infra. Morning, Vivek.
Well, good morning. The recently listed ports operational arm of the JSW Group, that is JSW Infra, is in focus. Economic Times has reported that the company is looking for an inorganic growth and is in talks with the SP Group, that is the Shapoorji Pallonji Group, and this is to go ahead and acquire the Gopalpur ports. Now, the valuation for this particular deal says that the enterprise value of this particular ports could be close to 3,000 crore, which includes the company's debt. Now, why would JSW Infra be interested in the Gopalpur ports? Now, remember, JSW Group has significant operations as far as JSW Steel is concerned, and Gopalpur ports, which is an all-weather port, actually has significant iron ore handling capacities. On the back of that, JSW's current capacity is around 158.4 million tons per annum, which could increase by close to 25 million tons per annum on the back of this particular acquisition. We reached out to the JSW Group. At this point of time, they said that no comments, but it will be an interesting development to track as far as the entire port space is concerned.
All right, thanks a lot for that. Well, here's a quick recap in case you missed out on any of these stocks with positive news flow. There's Axis Bank, Sonata Software, Sona BLW Precision, Chennai Petro, Chalet Hotels, CMS Info Systems and JSW Infra. While stocks with negative news flow, there's Tech Mahindra, Jubilant Foodworks and Indus Towers. But let's also get a handle on what's happening in the world of commodities. There's actually lots that's taken place given the kind of escalation that we've seen in the geopolitical crisis with the Israel-Hamas war. Manisha Gupta joins in for a roundup of all the action from the commodity markets overnight. Manisha, the commentary that has come in, especially from US President Joe Biden with respect to perhaps escalation of the war in Gaza, that has not, the crude market or the commodity markets have not taken that too well.
Oh, absolutely. And we have seen some premium buying come in here. So the crude oil price has gained 2% overnight. Apart from the military conflict in Middle East, it also is about the tight production that we've seen from OPEC. China is looking to widen its budget deficit as well. So this is a perfect recipe where you would see the commodity prices rise. That is, the tangible commodities continues to gain. So the crude prices are back at around $90 a barrel. And because of crude, you have rubber prices, which are now trading at a 14-month highs in the overnight markets there. Metals also have seen some strength come in on the back of China's stimulus announcements, and the U.S. Treasury yields now trading below 4.9% as well. That has been supportive. So whether it's about copper, iron ore, we've seen great price gains. The safe haven buying in gold is back again as well. We are inches away from that $2,000 per ounce mark. So every sector that you see, whether it's energy, industrial metals or precious metals, we are trading in the positive in Asia today.
Okay, thanks a lot for that, Manisha. Well, let's get in Deepan Mehta, Director at Elixir Equities, to join us for a quick check on a lot of stocks that we can discuss. Hi, Deepan. Good morning. Deepan, what do you make of Axis Bank's numbers? You know, it appeared there was more good than bad, but how do you approach the stock from here?
Yeah, Nigel, good morning, and thank you for having me on your show. I think stellar set of numbers coming in from Axis Bank, and I think even amongst the banking peer group, its valuations also are quite attractive. So I have to say that it could be a major outperformer over the next few quarters or so. It's just that the likes of Axis Bank, Kotak, HDFC, ICICI are a bit subdued because a lot of the investor and trader action has shifted to the PSU banks and the tier 2, tier 3 banks, where the growth rates are similar, but valuations are more attractive. At the same time, I think more money is coming into the small mid-cap fund, which is getting focused over there. And Axis Bank having a large proportion of FII holding is also bearing the brunt of FII selling. So that's the phenomena, but I think large private sector bank like Axis Bank can be a part of a core holding and can provide stability to a portfolio and deliver long-term outperforming returns.
Okay, what about Tech Mahindra? Deepan, how are you feeling about it? I know you've had this sort of, love-hate relationship with technology stocks over the last many years. But now it's, it's very clear, right, that there is a big slowdown underway, especially for some of these names like Techem. Would you be cautious?
Yeah, Sonia, thank you. It is a love-hate relationship, and right now it is on the hate side. Very, very disappointing set of numbers. And unless you have a contrarian streak in your investing strategy, we wouldn't want to touch any of the technology stocks. I was quite positive on even mid-cap tech companies, but over there also growth rates certainly are coming off. And since it's a large industry group and with large proportion in the sensex and nifty, and that's where most of our portfolios are benchmarked, we need to have some allocation to tech, and that small allocation to tech we are working it through the mid-cap IT stocks, the likes of Persistent Systems, Coforge, Tata Elxsi, KPIT, where numbers are still, I would say, decent. They're at least getting to that 14 to 18% type of growth rates, top line, bottom line. And that may sustain these kind of valuations as well. But other than that, large cap IT, so I don't know when the turnaround will take place. And they go back to the growth rates of 14, 15% or so. That's getting more and more difficult.
Deepan, good morning. A quick word on, something you're very familiar with, the BSE. Stock did very well yesterday, almost 1,800 now. Your thoughts?
No, I think BSE clearly now has a coherent strategy to gain market share in the options business. And it's playing out pretty well as well, to the extent that they have had the confidence to increase the transaction charges per trade in the options market. And some analysis done by us suggests that growth rates will significantly improve for BSE, could get into that 25% zone if these kind of volumes are sustained and they grow over a period of time. And of course, they have a valuable asset in the form of their 25% holding in CDSL. So on the whole, I think it's a company which seems to be entering a new growth phase. In any case, markets are strong and a lot of investors are coming to invest in equities. Certain technological and regulatory changes also have benefited BSE in the sense that every mobile or web-based trading app has to offer BSE as a trading option, which was not the case earlier. So I think a lot of effort has gone in by the BSE, and that's clearly paying off just now. And if this market continues the way it is and volumes keep growing, then I'm certain that BSE also can give decent returns going ahead.
Okay, all right. You were telling us about how you're disappointed with Tech Mahindra's numbers. In fact, we have, the management with us. The company's Q2 earnings came in well below street estimates. The revenues declined by over 2%. Margins have also disappointed. Reema caught up with Mohit Joshi, the managing director and CEO designate, and Rohit Anand, who's the chief financial officer at Tech Mahindra, to discuss the company's Q2 performance. Began by asking about the drop in revenues and if the management expects the negative growth to continue in the coming quarters. Listen in.
I think from a quarter perspective, we've seen a decline of 2.4%. 1% I would attribute close to 1% to the discretionary spends that we're seeing cut, and more towards the communication side than anywhere else, because overall the global industry dynamics are still not recovered. So that's causing a big drag. Outside of that, we see exceptional items both on revenue and cost, which is causing an impact for us. From a revenue perspective, we decided as we move into a long-term strategy for the company to clearly define what our core is going to be and what are the areas we don't want to focus on, and some of the impacts on not driving focus on those territories and business and service line and pulling out of that and ending some of the tough contractual positions from a long-term perspective has caused this impact for the quarter. So that on revenue side, you can assume that to be close to 1.4%. And on the margin side, it's around 260 basis point, where we have a one-time exceptional item. I think, as I articulated, I think we'll continue to do that exercise towards Q3, post which we think we get into a normalized, at least a good view of the portfolio. And as we articulate our long-term strategy towards April, we'll talk about what our focus on the core is going to be.
Okay, so because you're focusing on your core, you've closed certain contracts, you're not focusing on it. It's impacted your top line by 140 basis points and your margins by 260 basis
That's
points.
Right.
Can you quantify what the total contract value would be of the business that you're no longer prioritizing? Your quarterly revenue run rate is about $15 million roughly. So what percentage of that business you're no longer interested in?
In terms of the current quarter impact, you can...
No, I meant the overall size, right? Because this is going to run into next quarter. So
yeah,
is it $200 million in overall size that you want to exit, or more than that?
So it's difficult to say the Q3 numbers right now, because we're in the process, because there's a lot of dependencies. We have to work with our customers, we have to go through the details, and we have to look at those contracts. So I think while it's difficult to say what that number is going to be, all I can tell you that we will continue to drive that action so that we get towards a normalized view as we move forward versus having an exceptional item continue. So hence Q3 will be our window that we've kept for ourselves too, because it's a lot of detailing work that's going through the portfolio and the contracting and understanding all the nuances around it. So while I can't quantify a number, all I can tell you is that it's a part of a very detailed exercise where we'll make sure that it falls into a long-term risk and reward ratio that we want to drive for the company.
So these are low-margin products?
I mean, it's a mix of tough. It's a mix of tough returns, both from a cash as well as margins perspective, as well as tough contractual contracts where the risk is always higher versus the rewards that you want to get out of it. It's a mix of all.
Mohit, it's a tall ask for you, right? Operating margins at 4.7%. Even if you take into account the one-offs, it's still single-digit margins for Tech Mahindra. What is your game plan to improve it just in the near term? Because that's seen as a low-hanging fruit.
Sure. So, like I mentioned to you earlier, it's still very early for me to give detailed, quantifiable numbers about what can be accomplished in Q3 and Q4. And keep in mind, like I said, that I only take over from CP on the 20th of December. So we're still slightly over midway through the process of the transition. Having said that, as you've seen, we've already taken a few concrete steps, right, to streamline the organization and to optimize for the future. The one thing that we have done is put together a new organization structure with a consolidated delivery organization with a very clear sort of division into 6 go-to-market SBUs. We've hired some critical folks, including our Chief Operating Officer, and so are also putting together the talent team that will take us into the future. And obviously, dependent on the great talent that we already have within the company. Over the next few months, we'll be working very closely together as a leadership team to put together the plan for the business, the plan for margins, and the plan for the organization. But I expect that will take us till April, when we can get back to you, which again will be, maybe less than 100 days after I actually take over from CP.
So we will know about your big strategy, the overhaul that you could be making in terms of revenue profile, margins, and even for the business, only in April.
Yes.
Even BFSI has come down for you all.
Yeah, so from a quarterly perspective, BFSI has both operational and one-off items. I think in last quarter, we had a portion of the business which we stopped towards the second half. So that was there in Q2 last year. So when you compare year on year, that's the impact. Versus last quarter, again, as a part of some of the contracts in Asia that we had in BFSI, we've terminated those or ended those contracts. That's causing a dip in the revenue. But outside that, I think the segment still continues to be tough in terms of discretionary spend, and half of the impact you can attribute to the operational performance on the
Okay,
BFSI.
one word answer. In Q3, revenues decline, according to you?
I think we don't give guidance, Reema, you know that.
Directionally.
But I said, as I had mentioned, second half right now, looking at the numbers, doesn't look to be going towards a positive direction. So
And
you can take it more as a
H2?
flat view.
Does it get worse before it gets better?
Q3, I can't give you a quantum, as I mentioned, but Q4, we will have a normalized view, in terms of what the baseline looks like, and from there, as we move towards
So Q3 could be the bottom in margins, could be.
All right, well, that's the word coming in from Tech Mahindra. Let's slip into a quick break. On the other side of the break, we have an opening that, we have to trade today. The Nifty is implied opening, indicating a fall of around 117 points. Anuj will be joining in for a quick trade setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts.
Welcome back. There's 15 minutes to go for the pre-open session, and let's now go across to Anuj, who's joining us, not from right here in the studios, but he's in all the way over in Delhi. Anuj, hi, good morning. I saw snippets of that interview you did with Mr. Gadkari, so plan to catch the whole of it. And I hope the weather is Delhi-like. Here also, I must tell you that we were discussing in the morning, the weather has become a little better. Go on.
Good morning, Prashant. Yes, the interview was superb and the weather is really nice. And I must tell you this thing, the Delhi office is amazing. The new office that we have here is just too good. You have to come here and perhaps spend a week here. And the infrastructure, everything around here, I think it's...
I plan to later this year, hopefully.
Yes, it's good. Now, coming to market action for the day, Prashant, and since you used the word hope, and whenever the word hope comes in, it reminds me of the greatest movie ever made, The Shawshank Redemption, where there are two opposing quotes about hope, where Red says that hope is a dangerous thing, and Andy Dufresne says hope is a good thing and no good thing ever dies. But in market, hope is not a data point. So let's come to data points. It's clearly a market which has moved from peak greed to peak fear in a matter of a month. It's just taken 1 month for the market to move from peak greed to peak fear. Many technical indicators are in oversold territory, but then you know what? It can remain oversold for long, just like it can remain overbought for long. And while there are hopes of a short covering on expiry day, the screen is clearly suggesting that lower levels are coming and sharper correction is possible. In terms of levels to watch on the Nifty, the first support is 19,050, and then I think the bigger support at 18,978. But you know what? My screen reading and chart reading is showing signs that this market is perhaps now willing to go to 18,600. What is 18,600? It's the 200-day moving average and also the level from where we had the first move towards 20,000, which was not successful, of course, where we halted at 19,900. That move from the June low started at 18,600. So that's why I think it's possible that you maybe test that. And the texture clearly is sell on rally. On the upside, the resistance comes in at 19,228. The Bank Nifty is the one which has clearly broken the 200-day moving average. It's decisively below the 200-day moving average, and the next level to watch is 42,500. If that doesn't hold, it can be very negative. But then you know what? It's expiry day. There would always be a hope that there's short covering, but the market's looking very weak, no doubt about that.
Okay, the markets are looking very weak, and it's a tough place to be, right? Given you don't know which way the geopolitical issue will head as well. If things escalate over there, then perhaps it won't be good for global equity markets, taking our markets further down. Thanks a lot, Anuj, for that. Enjoy your stay in Delhi. Looking forward to catch up with you once you're back here in Mumbai. But till then, we'll take a short commercial break. We'll come back with the pre-opening rates. Also, Sudarshan Sukhani and Shrikant Chauhan will be with us for some technical trades. Stay tuned.
Welcome back. Well, we're bracing for a bit of a downtick to kickstart trade. The GIFT Nifty suggests that maybe we pull back close to around 100 points odd. What happens from there? It's going to be rather exciting. Do we go to that 200 EMA or do we see a bit of a bounce? Sudarshan Sukhani and Shrikant Chavan join us to help us out with just that. Good morning, gentlemen. Sudarshan, what's your view on the Nifty? I mean, last few days have been down days. Do you think we're approaching support zones? And what's the trade on the index?
Yeah, good morning. See, my view has been that this market is not a buy on dips market, and I don't recommend short selling because short selling is a very highly skilled endeavor. So just stay away from this market. I think that's good advice even for today. I can't tell you where the markets will stop. If I knew that, that would be wonderful. But I doubt if anyone knows the point at which this market will stop falling. So I don't do that. I don't even think about it. It's falling, and if it is falling, we have to stay away from it. That's the key point. Don't catch falling knives. Let the market settle down wherever they want.
Okay, all right. Got that on the index, Sudarshan. Shrikant, what about you? How are you feeling about the index?
Good morning, Nigel. If you go through with the price pattern of the market, then I think it is on the verge of completing zigzag correction between 18,900 to 19,000 levels. Also, if you go through with the Fibonacci retracements, then somewhere close to 80,950, the market is having excellent support in terms of its retracement ratios. So we are of the view that the way the markets have fallen and the put call ratio is at 0.5, 0.55, and retracement ratio as well as zigzag correction, I think close to or between 19,000 to 18,900, we should be buyer in this market with a medium to short term view.
Let's talk about individual stocks then. What are we looking at this morning? Shrikant, let me begin with you. Actually, Sudarshan, let me start with you because, I wanted your thoughts also on the technology stocks like Tech Mahindra. What does it do with that? And what are the other stocks that you're looking at this morning?
See, primarily in technology stocks, there are only two stocks you should be focusing on in the large cap. Those are the two big names, Infi and TCS. Everything else you should really not be having in your portfolio. Mid-cap stocks have some interesting ideas even then. In fact, one of them comes in my list today, that's Persistent. So in mid-cap stocks, there are opportunities, but otherwise, for example, Tech Mahindra or Wipro or anything else is an avoid. So to complete my list of stocks, Coal India is a buy. Just look at it, Sonia. The stock is actually rising in this market. Look at the outperformance. That's a stock that will run when the markets begin to move up, whenever and they will. Buy with a stop under 290. Biocon is an intraday short. Just the exact opposite of Coal India. It's falling and falling. It's an intraday short with a stop above 230. Persistent, I just spoke about. It's an excellent chart for a long-term investor, for a positional trader. Buy with a stop under 5,600. And finally, RBI Bank had those two big down days, and that triggers a correction. It's an intraday short with a stop above 238.
Okay, all right. Sudarshan got that. Shrikant, what about you? Individual stock picks?
Yeah, I think the way the market is falling and IT stocks are not performing, or maybe they are under a lot of pressure. In that case, we should look for creating some short positions on Wipro, because it is still far away from its important support area of 350, 360. So from current level, the stock can easily move or maybe fall to the levels of 360 in the near term. So it's a sale at current levels with a stop loss at 387. And the stock on which we are bullish is GNFC. And yesterday when there was recovery in the market, we saw some activity in all fertilizer companies, especially GNFC. It is around some 650, 640 levels. From here, the stock can easily move to the levels of 680, 690, where it has spent a lot of time when there was activity in the stock. So at current levels, GNFC is a buy with a stop loss at 630.
All right, thanks a lot for that. Let's take a short break on that note. On the other side, we'll come back with the pre-opening rates. Also, Sameer Dheer of Sonata Software will be joining in to discuss their Q2 earnings. Do stay tuned in. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Let's get straight to some F&O cues for the day. Chandan Taparia, the derivative and technical analyst at Motilal Oswal Financial Services, is with us. Chandan, hi. Good morning. How are you feeling about the market? It is a bear attack, so to speak, but what is the expectation and what are the stocks to look at?
Good morning, Sonia. Nifty has been making lower highs, lower lows from last 5 trading session, and bears are having complete dominance in the market from last few days. We have witnessed that every small bounce is being sold and key important supports have broken in the market, and that's why some more weakness could be there. We are trading lower than its weekly volume weighted average and the monthly volume weighted average. So even after being expiry day, posed upside or kept upside with selling pressure will continue to be in the market. Overall, we believe that till Nifty holds below 19,333 zone, this downside move can extend to us 18,888. That was the high made in the December 2022, and the next level will be 18,500. So 18,888 to 18,500 will be two key levels where we are looking for the downside move in the market. Now talking about Bank Nifty, that is holding well below key moving averages. Selling pressure is clearly visible. We are trading below volume weighted average, and this is trading lower at the last 5 months. Lower top, lower bottom is clearly visible. So downside level coming to 42,250, 42,333 marks. Now looking at the selective stocks, advanced decline ratio is negative. So I'll keep only 2 trades, one on the positive side, second on the negative side. First trade is buy on persistent system. This is one of the strongest counter which is not fallen even after the market decline. It is holding well, all set to give the consolidation breakout of last 33 trading session. Rollovers are even better. So recommending to buy on persistent system with a stop loss of 57.80, and this stock can head to us 61.40 level. Second trading area, that is sell on Tata Chemical. Most of the chemical fertilizer stocks are negative. We have seen built up of short position with sustained cold writing activity, and Tata Chemical is continuously making lower top, lower bottom, given the breakdown with built up of short. So indicating further weakness, one can sell with a stop loss of 980, and a stock can correct by 3 to 5% for the downside move to us 925 levels.
Okay, all right. Thanks a lot for that, Chandan. Wishing you a good day ahead. Well, let's get straight to our first corporate. We have Sonata Software. Well, the consolidated revenues for the past quarter saw a bit of a decline. The company, though, continued to witness a strong growth in the international IT services business. The IT services margins as well did see a bit of an uptick. Mr. Samir Dheer, the MD and CEO of the company, joins us on the show. Hi, Mr. Dheer. Good morning. Thanks so much for joining in. Well, let's focus on the international IT services business itself. You've grown at around 4.7%. Could you tell us how much of that was organic? And also in that business, the margins have moved up a little bit, closer to around 25%. Do you see further improvement from here on?
Yeah, sure. Good morning, first of all. So yeah, I think our messaging around modernization engineering is resonating well with our clients. I think that's a very heartening sign that in this market, when most of the industry peers have given results of flattish or degrowth or low single digit, we have been able to clock 4.6% quarter on quarter. And that's at the back of last quarter prior to this, which was about 4%. And that's at the back of the quarter prior to that, which was about 4.5%. So we've been consistently about the 4% mark quarter on quarter, which is a very heartening sign. As far as the numbers for this quarter are concerned, these are all organic numbers because the Quant acquisition that we announced in Q4 of last year is fully integrated at this point in time. So it's all rolled in number into one. There's no net new acquisition in the quarter, so it's all organic numbers in that sense. From a margin perspective, if you recall, we had announced last quarter that the 2 large deals that we had closed, and they were in transition phase in the last quarter. So we had taken the cost in last quarter, and this quarter we got the full upside of the revenue in this quarter. So hence the margin and the utilization have looked better this quarter. And these are pretty sustainable, robust margins. We believe will continue to be in the low 20s EBITDA that we have guided the street earlier.
Okay, Samir, hi, good morning and thanks for joining in. I had a couple of questions on the top line because you do have a guidance of $1.5 billion of revenues in the next 3 to 4 years. Can you just take us through the phase-wise, guidance that you're looking at? What will you do in the first year, which is by the end of FY25? What will your top line be? And how much of it will come courtesy M&A?
Yeah, so if you look at the architecture we put together, we said we'll be about 1.5 billion about a year back. We are in year 1 of that journey already, and we want to be 1.5 billion by FY26 end, the last quarter from a run rate perspective. And we're pretty much on that course right now. There might be a quarter or two here and there, but by and large, we're in the same zone that we had outlined for ourselves. Now, in terms of the breakdown, depending on the market conditions, we've outlined that we will be growing high teens to low 20s. In good years, maybe 20s. In tough years like this, probably high teens. That's really the broad guidance we had given out. It's hard to predict because the market has been quite volatile, as you see. But even in this market, we are pretty bullish about the fact that companies continue to do well.
Sure. The second part of my question was more to the contribution of M&A, because you do have about 700 crores of cash on your books. So will you be spending that for any acquisitions in this year or next? And how much of this $1.5 billion by FY26 will come through the M&A route?
Yeah, so we are not aggressively looking for M&A at this point, as we just closed one acquisition earlier this year. But if we do find some suitable properties which make sense from a Sonata perspective, we will not hesitate to do that. But at this point in time, we believe about 80 to 90% of this is going to come largely from organic. There might be a wee bit which will come from some inorganic acquisition, if that.
All right, Samir, just to confirm, you said margins in the international IT services business will hold in early 20s, is it?
The EBITDA margins, that is. So we have said long-term trajectory is to be in low 20 EBITDA. We came in this quarter at about 23, and we believe it will be around 22, 23 in that zone from a long-term perspective as well.
Got it. All right. Some peers are talking about a bit of a slowdown in orders getting closed out. Are you experiencing that, either slowdown or cancellations or postponement of orders that you're in talks with already?
Yeah, so I think we have seen a fairly secular growth trend across the board. So whether it's healthcare, whether it is banking, retail, manufacturing, we've seen a fairly consistent secular growth trend over the period of time. Now, of course, we've seen some slowdown and decision delays in the high-tech sector specifically, and that we had called out 2 quarters back. So that sector has been soft for us, as well as the decision delays have been there. But beyond that, in the other sectors and other geographies, we've been seeing pretty secular trend. There might be 1 or 2 accounts here and there, but in general, not anything to call out as a trend at this point in time.
Okay. Got that. So, I just wanted to understand, how are the deal wins looking? Because you said that there are 35 large deals that are under pursuit at the moment, and you are increasing your penetration amongst larger companies. So what can we expect in terms of deal wins, number of deal wins, even the kind of quantum that you're looking at on an average? What could the trajectory be? If you can throw some more color on that.
Yeah, sure. So let's talk about the order book. So I think even in the most recent quarter, we have been, the book-to-bill ratio is about 1.24, which is pretty healthy. So we feel there is no slowdown from a order book perspective. As far as the large deals are concerned, if you look at our track record, I think starting 6 quarters back when I came on board, we've been really clocking about 2 to 3 deals, large deals every quarter. And this quarter is no exception. We have announced 3 large deals even in this quarter, the most recent quarter, that is. So we believe the engine is set up to do 2 to 3 large deals every quarter. Of course, there might be some quarter which might be slightly more and some might be slightly less. But on average, we think we can close out between 8 to 12 large deals in a year. And that's really what the momentum that we are seeing. Now, these are all multi-year contracts. Once you get in, these are all digital transformation type programs. Once you are inside the program, then you tend to stay longer and continue to deliver value for the customers. Because the digital agenda, generally for the customers, whether it in the service market that we service, is very secular at this point in time. We have not seen any dramatic shift except for the high-tech industry that we called out.
Okay, just one final question from my end, Samir. You said that you can close out 8 to 12 large deals in a year. In the domestic business, you have renewed all of your large multi-year software contracts with your key customers. So you're not noticing any kind of slowdown either in deal conversions. There are no delays in deal wins, right, at the moment in the domestic business. And what would, specifically for that market, what would the trajectory look like?
So the number of 8 to 12 was for the international market because we're talking in the context of international. But from a domestic perspective, I think, again, in general, good momentum. But if you back out the IT and ITES segment, which is the tech sector, I think there are some decision delays there as well. But apart from that, the demand environment is still holding up by and large.
All right. We will let you go on that note, Samir. Thanks a lot for joining in. So the demand environment is holding up. They have a target of $1.5 billion of revenues by FY26 end. They're looking at high teens to low 20s in terms of growth, but not aggressively looking at M&A at this point in time. So that's Sonata Software. Keep that on your radar. But let's get back to the markets now. The pre-opening rates are settling lower. The Nifty is down about 90 odd points. Sudarshan is back with us. There are stocks like Axis Bank that could be in the green, while Tech Mahindra could be in the red because of numbers. Sudarshan, what's the big call at 9:10?
Well, persistent is a buy. It's a buy for positional traders and investors. Buy with a stop under 5,600.
Okay, and Tech Mahindra, thanks Sudarshan for that. And Tech Mahindra is the one that is in focus post their numbers, weak numbers. But Nimesh is here to give us the bull versus bear scenario on Tech Mahindra. Nimesh, over to you.
Hi, Sonia. So, as you rightly pointed out, very weak numbers from Tech Mahindra, a big miss on revenue as well as in margins. The revenue was down 2.4% versus estimate of 1% decline, and EBIT margin came in at 4.7% versus estimate of 6.3%. So, big miss on both top line and bottom line. The biggest pain was in the communication vertical. That saw a decline of 5% on a quarter-on-quarter. In terms of brokerages, Jefferies maintained an underperformed target price of 910. According to the note, for them, the key negative surprise was a sharp 5% decline in the CME vertical and single-digit margins. Similar was Macquarie. Even they have an underperformed rating, target price of 1010. They expect the communication vertical to be a big drag and unlikely to match the peer growth even in FY25. So that's from the Macquarie note. However, Nomura has a contra view. They have a buy rating with a target price of 1320. I guess they are the highest in the street in terms of target price. They believe it's a sinking year for Tech Mahindra. The new CEO strategy will be unveiled only in April of 24. But the saving grace was a 12 rupees dividend, which was announced this quarter. So valuation is a comfort. Dividend payout was a comfort, but a big miss on both revenue as well as in margins.
Okay, all right. Thanks a lot for that. Nimesh, Sonia, what about Sona BLW? A lot of brokerage have written, and we'll have the management in the next 20 minutes.
Yes, in fact, very good numbers, right? So a lot of brokerages have come out and upgraded the stock as well. So JP Morgan has upgraded to a neutral. They have a target price that they've raised to 475. Now, it's a very good set of numbers that Sona BLW has delivered. And they say that the stock has underperformed the Nifty as well, both on a 3-month as well as a 12-month basis, despite delivering a very strong EBITDA growth. So they believe that going forward, Sona can deliver 25% revenue growth and an EBIT compounded growth over FY24 to 26. CLSA has also upgraded the stock to an outperform. They've raised their target to 578. They say the company has added new product lines and customers to drive growth. And there's a very strong revenue compounding story here. And the valuations also are quite reasonable given the strong compounding earnings. Finally, Jefferies has a buy with a target price of 700. They say the company has delivered a good Q2 with an EBITDA and profit growth of around 35 to 39%. And they are focusing on the evolving trends in the mobility space. They've added several components across differentials, across motors. So this is one stock that they definitely like. In fact, we will be speaking to the management of Sona BLW Precision at 9:30 a.m. this morning. Vivek Vikram Singh, who's the MD and Group CEO, will be with us. But Axis Bank is also top of mind. So just before the market opens, let's hop across to Abhishek to find out how the numbers looked. Abhishek.
Well, the numbers were better than peers, especially on the net interest margin, where, it's a rare instance that a bank has seen improvement in net interest margin, like ICICI Bank saw a 25 basis point decline. Kotak Bank saw a 35 basis point decline. Axis Bank actually improved margins by 1 basis point, and that was thanks to the CD ratio improvement. Slippage ratio has declined for Axis Bank as well, and it is the highest decline amongst peers by about 41 basis point. Amongst large banks, the Axis Bank slippage ratio of 1.45% for Q2 is the lowest when compared to ICICI Bank at close to 1.7, Kotak at 1.5, and IndusInd at 1.9. Axis Bank, thanks to the lower slippage ratio, has seen improvement in its gross NPA ratio as well. And if you take a look, it's next best to Kotak Mahindra Bank at 1.73 times. The CD ratio is the highest for Axis Bank. As I mentioned earlier, there is improvement over there, and thanks to that, the net interest margin has improved. This also means that Axis Bank going ahead will have to raise deposits in order to have a strong loan growth. In terms of valuation, Axis Bank is not too expensive at 1.79 times price to book value FY24. That cheap valuation is due to the fact that there is no consistency in results. So if they perform consistently like this or how they have performed in Q2, there are chances of re-rating of the stock. Back to you.
Okay, thanks a lot, Abhishek, for that. Well, let's just get to the market opening now, which looks like it's going to be an ugly opening for sure. There are a lot of cues that the bears can latch on to this morning, whether it is weak global cues, whether it's a rise in US bond yields. We've had large FI selling in our own market as well. And now the Nifty has lost quite a bit of ground, almost 700 points gone in the last 5 trading sessions. So it's definitely a bearish market that we have on our hand. And today, in addition to all of this, there's weak numbers from the likes of Tech Mahindra. So that stock is your big loser this morning, down 3.5% in pre-opening, along with others like HCL Tech and Infosys also dragging its feet. So there's the first tick on the index. As I said, a weak opening, 95 points lower. The sensex is down 320 points. And the bank Nifty is down 150 points, so not looking good at all. Tech Mahindra, straight off the charts, is down about 4%, followed by something like a Bajaj Finserv, Hindalco, Infosys, Wipro, SBI, all in the red this morning. Let's also take it to the market breadth, because that's not looking good at all. Almost 1,500 stocks on the declining side. And then you have, names like SBI, Wipro, JSW Steel, M&M that are all under pressure as we speak. On the upside, the lone ranger this morning is Axis Bank, up about 0.8%, posts its numbers, very good numbers there, while IndusInd Bank is up about 0.6%. So that's it. Just Axis and IndusInd are the 2 stocks that are in the green. All the other stocks are in the red, and now the Nifty has hit a century on the downside, 100 points lower, barely hanging on to 19,000 by the skin of its teeth. But the broader markets are having a time worse than the frontliners. So take it away.
Well, that's right, Sonia. Jubilant Food, that's down close to around 4% as we speak. So in terms of negative reactions from the broader markets, that's getting a hard knock. But Sonia told us about Sona BLW, and that one in a weak market actually has opened up with a gain of close to around 3%. So let's get that one up for you on the screen. Ujjivan Small Finance Bank, well, that's another stock that's moving on high volume, so that one should come up for you on the screen as well. Ujjivan Small Finance Bank is the one that we're talking about. That's bucking the trend. In fact, no, it's down close to around 2.5% as we speak. MMTC down another 5% in today's trading session. And a few more notable movers, in terms of high volumes. Manappuram Finance is down close to around 2%. You have very, very few stocks that are trading in the green. And the breadth of the market is just one stock that's advancing for around 4 stocks that are declining. By the way, 19,000 odd mark has gone. 19,000, is just been breached actually as we speak. So 18,950 to 19,000. Well, if we have to bounce, we'll have to bounce from these levels. Otherwise, the Nifty in all probability will be moving towards that 200 DMA that comes in at around 18,600 odd. Prashant, what else?
Well, it's down, right? So 100 plus points lower on the Nifty is what we have. And just take a few other sort of stocks under consideration. Market breadth, maybe it's a little early to conclude, but 5:1 to begin the day in favor of declines is what we have. 1,500 stocks are down and about 300 stocks are higher. Jubilant Food is down 4%. It'll come up on your screen. Stocks at about 506. Varun Beverages is down about 2.7, 2.8%, 859. These are the largest volume-led losses. Welspun India is down 3.5%. Indian Overseas Bank was up 3-4% yesterday. It's down that much today, at least at open. Syngene is down about 2% right now. Syngene will come up. L&T Finance, 2.75% lower, 128. Suzlon, which consistently comes up as one of the top traded stocks, is down about 4% or so. Macrotech, that is Loda, is down about 4%. Max Healthcare is down almost about 4% or so. Titagarh Wagons is down 3.5%. Action Construction Equipment. There was Mac Power, which was up, I think, sharply yesterday, some 15% or so. It's down about 6% this morning at start. And then I can sort of go on, but then volumes start to thin out a little bit as we go down the list. But there is enough already in the mix as we start the day. Nigel and Sonia mentioned, Axis is standing out, and Sona is the other one, which is up about 1 and 3% respectively on these two names. And Sonata Software, the management was with us just a while back, is up about 1% or so as well. So, that's the overall action which is coming through. 119, 120 points lower is what we have on the Nifty. Well, let's welcome in our first guest on the program, Post-Market Open. Mihir Vora is Chief Investment Officer at Trust Mutual Fund. Mihir is with us in our studios. Mihir, good morning. Good to have you with us here, and good to see you in your new avatar, I should say. Long journey at your previous organization, and good to see you once again. But we are also meeting in the midst of a bit of a correction, Mihir. Yes. Is this likely to continue for a bit longer, you think, or how have you looked at markets recently?
It is a good correction, I would say. Let's look at the positives first. Negative, of course, is the market's down. Positive is that it's mostly because of global factors. I think the higher for longer situation as far as interest rates in the US are concerned is leading to a asset class correction across bonds, across equities, and that's kind of trickling down into emerging markets, including India, even though our standalone fundamentals are relatively much better than the rest of the world. So it's mostly because of global factors. Add to it a bit of the uncertainty as far as the Israel situation is concerned and the Ukraine situation is concerned. It means that probably the supply chain disruptions and inflation can remain higher for longer. And the fact that the US fiscal deficit has also been out of control means that bond markets globally are in a real state of panic, because there's going to be huge supply of US bonds. And you look at the long bond yields in the US, 10-year bonds, 30-year bonds, they are at 5% plus, which is frankly speaking not sustainable for them. So here the markets are basically a step ahead of the Fed, whereas the Fed wants to kind of stop loosening, but the markets are saying that you're going to have to issue so many bonds because your yields have gone up and refinancing of your maturities are coming up in the next couple of years, that you will not be able to reduce rates, which means that we might see a US slowdown or a sharp slowdown or even a recession sooner than expected. That's the concern.
You may not be able to hike rates further.
You may not be able to cut rates because they were saying the expectation was that next year, second half of next year, they might actually start easing out, but that's not going to happen.
Okay. Mihir, good morning. By the way, congratulations on your new role. And you did what, 9 years at Max Life before moving on. So long journey, and hopefully you'll have an equally successful one at Trust.
Thank you.
So congratulations. But for the market as a whole, I mean, this is a situation that we've seen deteriorate very rapidly. Just in the last 10-15 days, the market has moved from sort of a buy on dips to a sell on rally. But we also have a geopolitical crisis, something that we haven't seen in the recent past, right? So it is kind of creating a lot of caution in the system. From a retail investor standpoint in India, what do you do now? Do you raise your cash levels or do you continue to just keep your investments running?
I think the SIPs or the regular investment plans should not be discontinued for sure, because it's precisely because of such volatility that SIPs are there, because you'll buy something lower, you'll buy something higher. But in the long term, it works out. So the systematic plans, definitely, whether it's your insurance premium on a yearly basis or your SIP on a monthly basis, you should not definitely discontinue. Volatility is a nature of the beast. Like a 4-5% correction is something that we see 2-3 times a year in any case in the equity markets. So this kind of correction is not really something to worry about. I would be worried if we are worried about the long-term growth prospects of India, which is not the situation as of now.
Hi, Mir. Congratulations. Looking forward to coming across to your office, and maybe having a chat with you. But you mentioned at the start of this conversation that most of the fall is global in nature. Do you think it's, the mid-caps in particular, they ran ahead of themselves? And with regard to approaching to the Indian markets right now, most of your money would be drifting towards large caps rather than the mid and small caps, because there were signs of some frothiness out there.
Certainly. If you'd also, I think you've been following my tweets also. I've been mentioning this, that large caps, even at say 19,800 or 19,900, the Nifty was not that overvalued, in the historical perspective, given that we still expect 15+% of growth, earnings growth. So that's a healthy valuation, I would say, for the Nifty. But there was some froth built up in the small cap, micro cap, the SME index, the SME stocks, which probably naturally would correct faster because they went up faster.
Yes. I like that tweet, talking about tweets in the bull markets. What? The investors have the money, the promoters have the wisdom. But when it turns around, then the promoters have the money.
And the investors are left with the wisdom.
That was a good one.
Okay, so how are you feeling about individual sectors now? Because, this earnings season so far has been very patchy, to be honest.
Yes.
Some good, some really bad. And, some key pockets like IT have been struggling quite a bit. What has your reading been so far?
Exactly what you said. IT has been well, the results have not been so bad, but the guidance has been quite weak. So the visibility is reducing as far as IT is concerned. And as we discussed, it's natural because we are talking about less visibility as far as US and global growth is concerned. So IT would naturally be impacted in the next few quarters because of that. In the local economy, I think the capex cycle still continues, whether it's private sector capex or defense spending, railway. So that theme continues. We can talk about valuations separately, but the growth in these segments is likely to continue, especially the government-linked growth. And in an election year, frankly, I don't think the government is going to let down as far as spending on growth is concerned for the next few quarters. I would also expect some kind of populist measures. So I don't think the rural economy has picked up that well yet. The economy recovery is still a bit K-shaped in nature. So I think the government's thrust towards subsidies in the rural segment should also continue, which means that sectors like FMCG, which have not yet done so well, may start to see some action, though the results have not been that great.
Well, that capex point, the last data point indicates that new project announcements are down sharply. I mean, I'm talking about the second quarter data. I think this is CMI collects the data. They're down very, very sharply, and I think the bank credit growth also shows that lending to industry has actually fallen. I mean, in line with that data point. I mean,
yes.
Any thoughts on that?
See, as far as lending is concerned, the big corporates are not borrowing because they have enough cash flows to fund their own capex. It's the mid-sized corporates, and if you look at the order book of the capital company, they are not reflecting this kind of a slowdown, which means that a lot of the action and a lot of capex is happening in, say, 50 crore, 100 crore kind of mid-sized companies, and my guess is that a lot of it is because of manufacturing exports across the segments. We can talk about them later, but I don't see a sharp slowdown in capex spending by the private sector. I think it's just picking up, I would say.
It's picking up.
Yeah.
And any straight-off beneficiaries of that, and as you see it, which is you'd want to buy sort of companies which get these orders, right? I mean,
yes.
from the private sector side. So,
absolutely.
I mean, top of the mind ideas.
So there are multiple sectors. For example, in the power sector, you got metering companies, you got transformer companies, and a whole chain of companies in the T&D sector. And I think, given the way the grid is evolving, we'll need more and more investment in the distribution
infrastructure. I think we can talk stocks now, maybe.
Yeah, exactly.
Earlier we could not talk stocks.
No, I mean, can't yet.
Please give us some ideas.
I'll have to check with my compliance.
Yeah, a couple of names, notably some of those large names. We talk about the Nifty being at 20,000. Many of them didn't participate. Let's talk about focus on the large cap names.
1 minute. He was giving us names.
Yeah, that's what I'm not getting that.
Smart metering companies, you were saying.
Yeah. How much
what do you like there? I mean,
I still can't give
not
names.
That many names there.
Yes.
But what else, really?
So power sector, T&D will require a lot of investments. In fact, renewables is another big space opening up. I mean, we can go on and on, defense, railways, all those things that we have talked about so often. I don't think that's going to change in the next few quarters. That's going to continue for a while.
But
real estate is picking up.
These
after a long
stocks as
time.
well have already reacted. If you look at the smart meter plays, if you look at renewables as well, you still believe they still have a bigger runway because some of them are up, 3, 4, 5 times?
Yes, but look at the last few days. If the correction continues the way it is, you'll see old prices sooner rather than later, which means you should always keep in mind the medium-term fundamentals and wait for your price.
In terms of other pockets, right, there are so many pockets that have done well, whether it's defense, whether it's auto ancillaries, for example, and we're going to speak to one of them now in a bit, whether it is the consumer durable companies. Any of these pockets where if the correction deepens, you would sort of get into it, even real estate for that matter, ceramic companies?
Certainly. Ceramics is one area where not only are we doing well on the local front, but even exports are picking up. In fact, I read some reports where we might be one of the largest exporters of ceramics to the world. So that's definitely a pocket. So as I was saying, this manufacturing theme across segments is here to stay. It's not going to reverse in a hurry. Even if the global economy slows down, you may see a quarter or two of slowdown, but the China Plus One, outsourcing from India and Make in India, Atmanirbharta focus is for real.
But this capital goods theme is something that's come back after a very long time, right? The L&Ts of the world, BHEL as well.
Yes.
But these are companies that have, so people have burnt their fingers in them. I mean, especially names like BHEL. But you think in this correction that we're witnessing right now, it makes sense to buy some of these names despite the rally that we've seen?
See, certainly, for example, the government now realizes that relying completely on renewables for the next 10 years may not be a wise thing to do. You need conventional energy, conventional power production also, and where we have natural advantages. So, even thermal power we should not write off, and the stocks have been written off for so long that there is some value emerging there. So, and you talked about the capex theme coming after a long time. The difference this time is that the capex revival is not in mega projects. It's in thousands or hundreds of small companies investing in various kind of manufacturing, which is what makes me confident that this is more sustainable than before.
Okay, all right. Let's talk about the headline index, May, since you're not giving us any stocks, but we're still hopeful that in the next few minutes you do give us some. We have seen a 5% correction from the top. How much deeper can we go? As we speak, we're at the low point of the day. Those bounces are getting sold into. But on the headline index, if earnings are going to continue, if the capex theme is going to continue, the domestic-facing sectors are going to do well, how deep can the correction be on the headline index?
My guess is not more than 5 to 10% maximum from these levels, because we are already with the 5% correction and the fact that we've already passed 6 months of the financial year, we are back to long-term average levels of valuations as far as price to earnings is concerned. Okay. And earnings growth is likely to be about 15%, which is again kind of little more than the long-term average. So valuations at long-term average, earnings growth at a little above average. We are kind of in a relatively safer zone compared to say 6 months ago.
So another 5% correction is doable, but not beyond that, is what you think so?
Okay. Your thoughts on banks? Because we've had, compared to at least the rest of the universe, banks have done quite well this time, whether it's ICICI Bank, whether it's something like an Axis Bank as well. Would you, even HDFC Bank for that matter, despite the merger, right? Would you raise your allocation to private sector banks now?
Certainly, because they are really starting off with a clean slate. The balance sheet issues are past us. Retail lending is something that they're focusing on, which has better margins. And, the fact that banks still have the wherewithal to drive economic growth, and we haven't even seen the beginning of corporate credit growth pick up. So once corporate credit picks up, I think banks will accelerate even faster, even though we have seen credit growth, but I think credit growth can accelerate further.
Okay, all right. We'll leave it at that. Mihir, thanks a lot for joining.
Check with your compliance and we'll talk stocks, right?
He won't come back here next time.
We'll get him here.
All right, thanks a lot.
Thank you so much.
Thanks for joining in. Okay, well, let's move on now because we do have the management of Sona BLW joining in. That's the company on our radar. Remember, the Q2 performance has been solid, robust revenue growth of over 20%. Margins have expanded by 300 basis points. And the revenue share from the electric vehicle segment, the BEV segment, has risen to 27% now. Vivek Vikram Singh, who's the MD and CEO at Sona Comstar, joins us now to talk about that. Vivek, thanks a lot for joining in. Once again, another robust quarter. And I was going through the first half revenue growth, very strong at 22%. You're now sitting on a base of 1,500 crores. What is the outlook for the second half? Can you replicate this kind of performance? And what are we looking at in terms of a target for the full year?
Hi, Sonia. Good morning. A lot of questions to start the morning with. We don't give forward guidance, so we don't comment on full year numbers or full year projections. But yeah, we've done well so far. We've doubled since we listed. I think what we did in profits and EBITDA in FY21 entire year, we've done in the first half of this year. So yeah, our growth's been consistently strong and we hope it will continue. There's no reason for it to not continue that I can see. That's all I can say.
Okay, so when you say there's no reason to not continue, I'm just trying to understand whether the pace of this growth is something that can continue. This 20% growth that you've seen, is this something that you can sustain? Because now you're seeing increasing number of orders in the BEV segment. You've just secured a new order from a North American OEM player as well in the electric vehicle space. So just trying to understand that, is this 20% growth sustainable, or can you even do better than that in the second half of the year?
So yeah, our growth in the last 22 years has been about 30% CAGR. So if we've sustained for 22, we should be able to sustain for 23, 24, 25 as well. Even in the last, I would say, 4-5 years, our growth CAGR is around 30%. So yeah, it should be sustainable.
All right. Hi, Vikram. Good morning. Nigel on this side. Vikram, your stock price is up in a market that's falling, tells you the kind of investor interest we're seeing as well. But I was just looking at your presentation, a couple of aspects stand out. The differential assembly, that is roughly around 20-21% of your total business. And for the last few quarters, the revenue number is stagnating in this 160 to 170 crores. Yes, on a year-on-year basis, it's looking much better. But on a quarterly basis, this number is stagnating. Is there any kind of concerns with regard to demand on the EV side of things in America as well as in the UK?
No, not really. And see, our business, I know you guys have to study a lot of businesses and analyze them. Our business is not one in which you look at quarters, because when new programs or new car models are launched, only then would you see a big jump. So what you'll see is a more, square type of function where you will have a spurt in growth, then you will stay for that kind of product for a bit at the same revenue numbers, then it goes up again when a new program launches. So I would say year on year is a better way to compare. Second, when doing these things like quarterly adjustments, every car maker in the world, a couple of weeks in each season, so 6 months, will take a break, for scheduled downtime, for maintenance, etc. So you will suddenly see that up and down. But that doesn't, I won't read too much into it. The year-on-year comparisons are far superior for that reason.
All right. Vikram, the reason I asked you that is because from the next quarter onwards, that year-on-year comparison will catch up. From the next quarter onwards, because you have been doing this 155 to around 170 crores on the differential assembly business. That's the only reason I asked you. But as you said, you're expecting it to continue in this vicinity. The short point I'm getting to is there's no concern, right, emerging on EV sales in the Western world. You don't see that happening. You see a bit of a consolidation phase.
No, not really. We have a pretty solid big program launching soon. So as soon as that starts ramping up, you will suddenly see this number go up a lot. And then a quarter after that, if you ask me why hasn't that grown Q on Q, it will be again a hard question to answer, because ramp-ups take time. We keep winning new programs and new customers. So there is a lot of those things. EV growth in the Western world has actually taken a bit of a pause, but that's also because I think automotive growth also has taken a pause. I think the share of BEV to total has been hovering around that 10% for the 2 quarters. So if we were just supplying to, let's say, 1 or 2 people on 1 or 2 models, of course it would be a concern. But if you keep adding more programs and you keep adding more customers, you're not just growing with the industry. What you're doing is you are growing with your customers, plus you're increasing wallet share and you're increasing market share. That's the only reason. If you look at our growth again, and I'll point to that, if you look at the last 8-9 years, we've grown at about 30%. Industry would have grown in low single digits in this period.
Got it.
The reason is more than one product, I would say.
Yeah, no, absolutely. So Vivek, hi, good morning. Prashant here. So will that kind of growth rate continue without getting very specific about 24 or 25? Or do you think one needs to moderate that? Because as the base also gets a little bigger, that is one. And second, you said there's new programs which will kick in. Could you explain that a little bit? And are you talking about the light differential, I think, which you mentioned earlier as well, or what exactly are these new programs and what kind of ramp up are we expecting?
So good question, Prashant. Obviously, as scale increases, growth gets harder and harder to maintain. I know when I started working here, we were a 350 crore company. That was FY16. If you double the first half, just annualize it, we will close at 3,000 plus this year. That's 9 times in 8 years. Obviously, as you gain scale, that kind of growth rate becomes harder. But at least for the next near term, which I say 3-4 years, this 20 to 25, 30%, that kind of growth is fairly doable. We know that because of our order book, and we fairly transparently share our order book. So that is known. What happens after we hit 1 billion type revenue, that's the one we have to solve. That's what we as management are trying to solve for today. So when you mention the lightweight differential or the new products we're launching, they won't solve anything in the near future or the next few quarters. They are there to solve for FY27, FY28, FY29, because that's when your growth rate starts dipping, right? So you have to start planning 3-4 years earlier, because also in auto, the first RFQ to purchase order takes about 9 to 12 months. Then purchase order to SOP takes another 18 months. So what we do today, we will reap the rewards 3 years later. So yeah, that's the plan. Hope we continue doing it as long as possible.
Sure. Vikram, I want to understand a little bit about the global electric vehicle landscape as well. There are a lot of new products that you folks have gotten into that we've spoken about, but I want to understand which is the product that's giving you the most traction globally, and also geography-wise, where are you seeing the maximum amount of traction now from a global EV landscape point of view?
So good question. I mean, our EV revenue has certainly grown. This was our highest EV revenue ever, 207 crores. The products that we are gaining most traction and most acceptance, and I think we will have double-digit market share of the world, would be the electric vehicle differential assembly. There, at least for all the complex drivetrains out there, be it the highest end of the vehicles, there we have done fairly well. I mean, we are, if not number one, number two always supplier anywhere. Most likely we are number one supplier on that product. Second product that obviously has been exciting, which 2 years ago was just 0% and now it's reached 5% of our revenue, was traction motors. But there we're not very global. We are still an Indian player. I would say we are the largest in India in that electric two-wheeler, three-wheeler market share. That also continues to grow quite fast. As a product segment, it is the fastest growing. Third, and hopefully that launches in 2 years, will be our intelligent suspension motor that adjusts the car chassis proactively. So it will judge, it will assess the road conditions and raise or lower the height of the car to give you a better ride. So that will be the third most exciting product that should hit the road in a couple of years.
Okay, so that's on the product side. So 3 of these products are doing very well. Of course, lightweight differentials and traction motors, as you said, doing very well at the moment. My second part of my question was on the geographies, right? Which are the geographies where you're seeing maximum potential, not just for your own company, but from a global EV landscape? And given that you are seeing a lot of potential in these new products, do you have a propensity to increase your operational performance as well, your EBITDA margins further because of this?
So markets, North America, Europe and India markets, relatively, I think this time Europe and India have done better than North America. North America had some temporary issues with the UAW strike against the big 3 OEMs. But like I said in the beginning, it is indeed a very good morning. I woke up to the news that that strike is in its end game. Hopefully in this week or next week, we should see the end of that strike. So that's really good news for us. So now that America will also pick up now. So yeah, all 3 markets doing fairly well. I think the only segment not doing well would be the off-highway market in India. Apart from that, I guess everything's doing actually pretty well. But you have to also keep in mind that in the last 3 years, auto has been quite down. 2018 was the peak of the auto world, right? Light vehicle sales hit 96 million. We are now doing 82, 83. So even now, it's relative to the really bad last 2-3 years. We are still nowhere close to where it could be. So frankly, I think, as you guys study, the Indian auto component industry can gain a lot as this 80 goes back to 96.
Sure,
a lot of the supply chain. So it should be a good outlook for some time.
No, the second part of my question was on margins. This 28% figure that you clocked in the first half, how much can you build on to that in the second half?
Yeah, I was trying to not answer it because we don't like increasing our margins by too much also. 25 to 27%, as I told you when we did IPOs, is our target range. Growth, margin and return, a management team has to balance all 3 financial metrics. So having one do too well at the cost of others is also not a great thing. So we will maintain that, around that 26, 27% mark is what our target range is.
Okay, all right. Got that. Vikram, final question from my end then. You were talking about doing close to around 3,000 crores. Mathematically, that should definitely be possible. But at peak revenues, what can you do, given the kind of growth that you're talking about, given the kind of deal wins that you're looking at as well? With the current investment, what's the peak revenue potential?
Yeah, it will be hard to calculate for me with the current investment because every product has a different capacity utilization. So what I have to do is divide that product revenue by the capacity utilization and get it. But yeah, still, I would say 5,000 crore with the current kind of capacities we have easy, but we are almost always in a capex thing. We are always investing. There is no time in the last 5 years that we've not been building a new plant. So that will all continue for some time, at least like I said, to Prashant's question. Next 3-4 years, we do not see ourselves slowing down.
Yeah, no, and the only question is after that billion-dollar mark, as you said, right? Just one last question. You know, we hear so much on the electric front, technology changes, right? Is the template kind of set? You know, there was a auto show in Japan. Toyota, for example, featured some new models. There's a lot of hullabaloo around it. Is the template set, or is the template still evolving? And I mean, is it just about the type of battery, a solid state, or is it? I mean, the overall this new vehicle away from ICE that itself is in its evolutionary phase. Quickly, Vikram.
Excellent question. I wish I could just do a very quick one, but I will say no.
No, so take your time, please. Go on.
It's not set, right?
Okay.
Powertrain change is a very, very big process. It requires tens of billions of dollars of investment per car maker. So it's not something that happens easily. The ICE powertrain, when it was launched in the 1900s, it took about 25 years to finally settle. The product that we make most of, differential, took 30 years to come into the car. So no, it's not settled. I think the battery chemistry is not settled. I don't think LFP is the right answer. Maybe a far, far better battery pack exists. What I do know is that alternate fuels plus electric will be the future. Most likely it will be electric. I would say 9-1 odds if I were betting on it. And what I would say is electric cars will become far, far more affordable. The cost to produce them eventually, after a 5-10 year, when it settles, will be much, much lower for the OEM to produce, and hence these vehicles will be far more affordable. Which is why we as a company keep trying to innovate on our products, and if we try to cannibalize our own product. This time we announced an integrated motor controller rather than selling both of them separate. We're saying, why not make a product that, you know, combines both of them? Lightweight differential, by the way, also means that our price will reduce. Why are we trying to do that is so that nobody else can come and do that to us. We would rather kill our own product with a better product than have someone else do that to us. So that's what it is. I think chaos will be there for some time, and it will be a lot. But chaos is also a ladder for people who know how to climb it. So it's a good times, I think, for agile companies.
All right. BEV is around 27% as of the last quarter, as a percentage of your revenues. In the next couple of years, where do you see this number headed? I'm just looking at a brokerage note. They're talking about 38% in FY25. Seems very doable, right? Going by the pace of growth and what's in the pipeline.
Yeah, should be very doable. I think our FY26 target, if I'm not wrong, is 45 to 50%. That's 45. For our ESG goals. So 38 in that interim year should be doable.
Okay, all right. Vikram, it's a pleasure having you with us here, and great conversation. Really, I really enjoyed it, and so did my colleagues. Hearing that perspective, I mean, pretty well-rounded. So good luck to you as you navigate through that chaos and climb the ladder, as you so well put it. Thank you very much for joining us here on CNBC-TV18. Well, I think we have to just take a quick look at the market. The Nifty is down 200. While we were in conversation with, Vikram there, we've seen sharper cut coming through, and we are now going through some levels. So 18,900 is where the index is at right now, which basically then means that we are down for 3 days in a row, sharply down for 3 days in a row. And we are coming closer to that, 18,700 kind of zone. We're closer there than we were yesterday or day before yesterday. That is essentially around where the market spent some time before the up move started. So that's about 200 points out, but this is looking pretty ugly out there. Sonia, just look at the market breadth, right? 10:1 is what the market breadth looks like. 10:1 in favor of declines. So many more names are now sort of in the mix on the downside. Just a few names I'd like to take. Zomato is down 6%, not there in the morning, but Zomato, these intradays perhaps will tell you the story. BSE started lower by 4%. It's down almost 7%. Jubilant, Varun Beverages, I think we were talking about earlier. But some of these railway stocks, right? IRFC, RVNL, these are all down 7-8%. There is Adani Power, which is down about 6% or so. I think Cochin Shipyard was down in the morning, but it's down more, about 6.5%. Apar Industries is down sharply, 6.5%. Lodha is down even more. So, yeah, I mean, there are newer names, and what was down is down more as we track markets. And this is just the first hour or so of today.
Oh, it's quite ugly, actually. You know, just pull up the mid-cap index. It's almost a 1,000-point fall that we're seeing on the mid-cap index right now. 2% is gone straight off the back, and we're not even half an hour into the market opening. The market breadth is now very weak, the weakest we've seen in quite a bit. 1:14 now in favor of the declines. And a lot of stocks, look at Macrotech Developers, for example, 8% gone on that stock. Zomato's down 6%. So this is a market that's really taken it on the chin this morning, not looking good at all. In fact, let's slip into a quick break. On the other side, we will be joined by Nikun Sanghi, the Managing Director at JS Four Wheel Motors, and Manish Ratsinghania, the President at FADA, to discuss the festive demand trends in the auto sector. Stay tuned. Welcome back. This is Corporate Radar. Not looking good at all for the markets now. In fact, the Nifty is at the lowest point of trade, extended its cut to almost 200 odd points, and the mid-cap index is bearing the biggest brunt. So the broader market really is taking it on the chin this morning. But let's get a quick word in on what's happening with festive demand, because the auto industry has looked pretty good. Maruti Suzuki told us yesterday that the industry has seen a 20% growth in sales since Onam, which shows that the auto industry is witnessing a strong festive season so far. To discuss more on the demand for the entire sector, we have Nikun Sanghi, the Managing Director at JS Four Wheel Motors, and Manish Ratsinghania, the President at the Federation of Automobile Dealers Association. Gentlemen, morning to both of you. Nikunj, let me begin with you. How has your reading been for the festive season so far? Which are the pockets that have done the best, and which are the ones that are still struggling?
Good morning. I think I'll first give the good news. I think two-wheelers, passengers, cars, both are doing exceptionally well. And specifically, if you look at the election states, I think they seem to be really booming. And to me, what is looking really attractive is sales returning to Hero. Hero has been struggling for more than 2 years now. And when I see numbers coming back to Hero, it definitely is a sign that even the entry-level segment is coming back into action, and the festive demand even at the entry-level segment is good. I'm not surprised Mr. Srivastav talked about growth coming back to Maruti, and Maruti is strong at the entry level on cars. So I think that's the good part about the automotive industry. And I think this festive season is going to be very, very positive and very, very good for the auto industry.
Okay, that's great to hear, because, you know, it's just in the last 1 to 2 months that we've heard that there is a comeback in the entry-level segment, right? Manish Ratsinghania is also with us. Manish, would you concur with the view that Nikunj has put out, that finally we're seeing some respite in the entry-level segment? And what has your reading been of the festive season so far?
So yes, I think we can definitely say that there has been some improvement in the entry-level segment. Our September numbers also reported a 21% growth overall across industry, and the best part was two-wheeler did around growth of around 22%. And this festival season also, two-wheeler seems to be responding much better than the passenger car industry. And two-wheeler dealers had been struggling across the length and breadth of India. And this is a definitely uptick. And while transforming, in fact, I was talking to a few two-wheeler dealers yesterday. They were in fact cribbing about the non-availability of the stock. So the potential seems to be better. And what Mr. Sanghi rightly said, I think he is also a hero dealer. He knows the pulse of the market there. And we have also seen during festival times, the rural market kind of, comes out in spite of, being under stress and all that. But during festival times, during Muharram times, customers have definitely taken a call and come out and purchase their choice of vehicles. And this time also the trend seems to be like this. And if this trend continues after festival, then we can definitely say there's a revival of the rural market as well as the entry-level segment.
All right, noted that point, Mr. Singhania. And the two-wheeler registrations number is up by close to 20%. I'm reading out from a note that we've got early this morning. But on the PV space, if you compare this festive season to the 10 days of last year, it's in fact, up only around 4%. So is that lagging?
No, I don't think it's lagging actually. PV sales were already at a very high peak. We had created kind of new records, and everything going forward is a new record. So, and availability of, there was shortage of demand last time. This time, availability of products are better. SUV continues to perform well. Semiconductor crisis has slightly settled down. So everything looks positive. Dealers have accumulated stock to address the consumer demands. So I think even if a 4 or 5% single-digit growth in PV, that's a decent thing. And passenger vehicle buying is more towards Dhanteras and Deepavali time. So I think we can definitely see a better figure during those times.
Okay. Nikunj, you started by saying I'll give you the good news, which is two-wheelers and entry-level cars are doing well. What's the bad news this time?
Well, the bad news is that availability, specifically on the SUV front and top-end SUV front, is not as good as we hoped it would be. And I think if it improves there, the numbers will be much, much higher.
All right. We'll leave it there, gentlemen. Great speaking with both of you here. Appreciate your time here on CNBC TV18, as always. Let's just focus on the back on the market, which is selling off hard. We are down almost 200 points now. We have Nagaraj Shetty, technical research analyst at HDFC Securities, joining in now. Nagaraj, good to have you with us here. It's a pretty red-looking screen out there. So immediately, what levels come to mind, and any observations on the headline indices first?
Yeah, hi, good morning. Nifty has been in a sharp downtrend over the last few sessions. And recently, over the last 3 sessions, we have been witnessing a selling momentum is taking on. I'm expecting this downside momentum is likely to continue for some more period. And we know that technically, we believe that supports are tend to be broken one after another. And I'm expecting the nearest support to be taken is around 18,800, which happens to be a 200-day EMA, which is very crucial support. I don't say that this support is going to hold and we are likely to see upside bounce. But technically saying there is a support at the lower levels, and having declined from the highs continuously over the last few sessions, indicators become oversold, and we may see some consolidation or a support taking for the indices at the lower levels, something around 18,800, 750, 800 odd levels.
18,800, 18,750, got that, Nagaraj. But what about the Nifty Bank? That's taken a harder knock. Now that's just broken 42,500. What's the support level out there? Is it nearing some kind of support, or do you expect it to see a sharper correction?
The similar kind of a movement we have seen in the Bank Nifty as well, in fact, more severe than the Nifty. And I'm expecting there is no, though Bank Nifty has declined much in the last few sessions, there is no indication of any clear-cut reversal as of now. So 41,800 to 41,600 is going to be the next support for the market for this banking sector. And I'm a little doubtful whether we could see some significant upside bounces from the lows or not, because the overall trend structure of the market from the smaller to larger time frame, including Bank Nifty, has damaged and turned into a negative. Overall indicator chart pattern is showing weak bias. Then the momentum is happening on the downside. So more weakness is likely for the Bank Nifty, and the next support will be around 41,800 to 41,600 levels.
41,800 to 41,600. So more weakness on the Bank Nifty. Are you seeing more pressure on some of the IT names? Because, even fundamentally, IT stocks are not doing that great in terms of earnings. But will that be another drag in terms of leaders taking the markets lower?
Yeah, of course. Strategically, if you look at the IT has been in a downtrend since past. If you consider the index from the 33,000 levels, where the IT majors are participating on the downside. Now, currently, the downtrend is likely to continue. This IT sector itself has broken below the important supports recently, and I'm expecting the IT major participants are likely to continue their downside momentum for the near term.
Okay, sorry, just one last word, Nagaraj, on the mid-cap index and the small-cap index. On charts, how are they looking?
Yeah, of course, it's an interesting chart pattern. Have you seen, if you look at the mid-cap and small caps over the last few months, and what you have seen a significant upside momentum from the April to almost the month of September, October. After that, this has started to show consolidation. We have seen some phenomenal upside momentum in the mid and small cap without showing any reasonable downward correction. This cannot be continued for long. Exactly what is happening is the mid cap and small cap is turning into a sharp downtrend. A selling momentum is picking up in the mid cap and small cap. Just beginning, I think I'm expecting more severe correction is likely to come in prominent mid cap stocks and small cap stocks, which have moved up significantly over the period of time recently. And this momentum, the selling pressure is likely to continue for the both mid and small cap sectors for the near term.
Okay, thanks a lot for joining in. It is indeed a very weak start to trade. The Nifty has now given up on that 19,000 mark as well. 18,940 is where we're at. It's almost a 200-point cut on the Nifty as we speak, not looking good for the bulls. But the Hinduja brothers have confirmed their plans to hike stake in IndusInd Bank. The three brothers, Gopichand Hinduja, Prakash Hinduja and Ashok Hinduja, spoke to CNBC-TV18 Sanjay Suri in London. Ashok Hinduja said that they will try to buy IndusInd shares from the open market once they finish raising capital from shareholders by November 15th. Hindujas also say that they have funds queued up to take over Reliance Capital and are awaiting the green light from the courts. They hope to complete the transaction this financial year itself. Listen in.
Ashok, are you now planning to up the stake in IndusInd?
That's right. So the regulator has already modified the policy a few years back, and now they have in principle given us the clearance, and we are raising our capital through the shareholders, which will be by 15th November will be concluded, and post that we'll be in the market to either start buying from the market or we will wait for the opportunity for the bank to raise capital.
And with Reliance Capital, there have been some questions raised about the source of the funding. Could you tell us a little about that?
I think all the information, the news which has come, we have not even applied to IRDA. So where is the question of rejection? So funds are all queued up. We have to only select and finalize. We will wait for the opportunity as and when the NCLT clears our proposal. After that, we are hopeful during this financial year, this whole transaction will be completed.
And sir, you have been the pioneer in scouting the world for opportunities for the group. What's coming next?
Well, as I mentioned that I come up with new concepts and new ideas to see how everybody can benefit from my contribution. So we have a lot of ideas in Saudi Arabia, in UAE, and of course in China and in US, how we can benefit with Africa, India to bring into that whole, because Africa is going to be the next continent of the world.
In what businesses?
Well, in field of, BRT, exports of, vehicles, Leyland vehicles, Gulf oil lubricants around over there, and plus to bring growth and partnership. So there's a lot of areas where we are looking in this.
And we're looking at growth of Ashok Leyland in India as well.
Exactly, as well.
The Lucknow plant? Or what's
when the exports will take place into the different part of the world, there will be a growth.
What you are asking about Lucknow, we are already committed and we will be moving forward.
Okay, that's the big interview with the Hinduja brothers. You'll hear about them through the course of the day. But for now, let's take a break. When we come back, Manisha Gupta will be joining in to give us an update on what's happening in the commodity market. Stay tuned. Welcome back. You're still watching Bazaar Morning Call. We are also talking about the commodity markets this morning because there's plenty of stress in the equity markets at the moment. So let's get a quick handle on what's happening in that market. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at gold, and it clearly has been a safe haven. What amazing performance that we've seen in last month or so. If you look at the overnight markets itself, we saw the gold prices gain up by 0.5%, but we are up 1% for this week. There is strong amount of investment buying that the gold prices seem to be looking at this point in time. It is a safe haven. There is portfolio diversification, and this also is a festival season. So there is buying coming in for the gold prices, and expectation that the prices will only rise going forward also has led to interest coming in here. So we are 1% on the week here, 5.5% for the month of October until now. And in last 1 year, gold has outperformed various asset classes, giving you returns of nearly 20% there. If you look at the fundamentals, those have been on the positive side as well. We have seen support come in from the geopolitical crisis. As I said, with the way the markets are anticipating that interest rates will decline in the coming year, there is that sentiment also playing into the prices. This is the latest number that we saw come in from China, where the gold consumption has gained up by 7.2% in 2023 until now. The Indian buying also has been stronger. The markets anticipate that fourth quarter of this calendar year, which we are into right now, with record weddings and festival buying, the Indian markets could also be looking at gold sales as high as 10 to 15% on an year-on-year basis. The other reason is that you have seen support is that we have seen currencies continue to decline. So gold in the month of October has hit an all-time highs in Australian dollar, Japanese yen, Chinese yuan and Taiwanese dollar as well. It was in the May of this year that we saw gold prices hit an all-time highs in the Indian markets as well. So when you look at all of these currencies, by the way, the Australian dollar is trading at a 50-week lows versus the US dollar, Japanese yen at a 12-month lows and Canadian dollar at a 30-week lows. That in turn also seems to be supporting gold buying in various of these currencies. What the street is looking for right now is the third quarter GDP numbers that come in today, with an expectation that the number could be at 4.2%. The US inflation numbers come in on Friday, and you have the Fed meeting now in the next week. So this is going to keep the investors quite busy, and the expectation that you could be looking at support continuing in case of gold prices.
All right, Manisha, thanks very much for that. So that's commodities in focus, and gold is shining. We'll take a quick commercial break here. On the other side, our special segment, Indianomics. My colleague Lata will get chatting with Jairam Sridharan of Piramal Capital and Housing Finance, Krishnan Sitaraman of CRISIL Ratings, and Somikanti Ghosh of SBI to discuss the unsecured loans picture across banks and the financial landscape. Stay with us.